Some people would say that the Fed has no choice but to step in and do everything it possibly can, Howard. But by doing what it has done, do you worry that it has set the stage for more recklessness in the future?
First of all, Eric, I am absolutely among the people who believe that the Fed had no choice. Thank God that it did what it did. We were, Bruce and I were, go back to March 18th or 19th, we were just actively discussing the possibility of a global depression, of a multi-year, very serious economic impact. And the Fed and Treasury and other central bank actions have, we believe, prevented this. And nobody's talking about global depression anymore. So I'm absolutely among those people. But it's very important to note that just because something has unforeseeable negative consequences, that doesn't mean it was a mistake. I believe that there may be negative consequences from these actions, but certainly that doesn't mean they shouldn't have been undertaken.
For now, the Federal Reserve has drawn the line at fallen angels, investment grade bonds that were downgraded to junk. And we've talked about what that has done for the investment grade market. And the Fed is also buying, at the moment, high yield ETFs.
Right.
What if, Howard, the Fed goes further into junk territory? What if it decides that it's okay to buy double Bs or perhaps even lower rated debt?
Well, Eric, there are also people who believe that one of these days the Fed may turn to buying common stocks. So, the buying of corporate bonds is a first. And what they've demonstrated is that there are no tactics that they won't engage in. There are people who believe, by the way, that it violates the rules under which the Fed acts, but they're doing it anyway. And they'll argue later about whether or not it was okay. Yes, they'll do anything. Their arsenal has been described as limitless. I still believe that it'll only work as long as it works, and as long as they're actively doing it. Look, Eric, what if the Fed said, we're going to be the buyer in every transaction? Every bond transaction, every stock transaction, we're going to be the buyer. The Fed has an unlimited checkbook. Our checks never clear, so we're gonna buy forever. This Fed has increased its balance sheet up to 10 trillion. There's no limit. We'll buy them all. Well, in theory, they could do that, and in theory, if they bought aggressively, they could make all the markets rise. Now, everybody would know that that's a Potemkin market, that it's a fake. And the minute they stopped, things would collapse. Certainly the Fed buying would drive out all private buying, because we'd all know that the Fed is paying too much money. The question is there any reason why they couldn't do that? I don't know. In one of my memos, I said, why doesn't the Fed just send out a check to $1 million check to every American? It would only cost $350 trillion, and we'd all be rich and prosperity would return. And so the question is, facetious, the question is there a downside to things like that? Would there be negative ramifications? I have to think so. I don't know what they would be. So will there be negative ramifications to the Fed's buying of fallen angels and high yield ETFs? I don't know. Would there be further ramifications if they bought single Bs, if they bought common stocks? I don't know. I believe so. Here we are, our GDP is 20 trillion, and we have done securities purchases and stimulus and support in many trillions in 1 2-month period. Are there limitations to what can be done? And are there ramifications? I believe so. But, this is not a science. We'll see. what they are.
Howard, how do these considerations and concerns affect what Oaktree is doing, affect what Oaktree is buying, and when Oaktree is buying?
Sure. Well, we were a very active buyer in the public debt markets in mid-March. And then on the 23rd or 4th of March, the government and Fed started to talk about what their program would be. And around the 26th, they announced it. And that drove up prices in the public credit markets to the point where we're not buying as aggressively at this point in time. So it has changed the market from what it would have been if they hadn't gotten involved. And that has had impact for us. I think that's inescapable.
Do you think investment opportunities are likely to improve from this point forward, where you will see the opportunity, the possibility of making elevated returns again? Or are we sort of here now and here for the time being?
Well, you tell me, will the Fed decide to be the buyer on every transaction? In which case prices don't ever have to go down. In theory, Yogi Berra said, in theory, there's no difference between theory and practice, but in practice there is. But let's talk about the future in a serious way. So I mentioned that the rating agencies believe, and the investment banks, that between 15 and 25 or so % of the high yield bonds outstanding will default. That's roughly $400 billion. That's a lot to buy. In April, I believe there were 19 defaults or bankruptcies, and I believe that's the greatest in history, greatest single month in history. And we're just getting going. Defaults and bankruptcies largely occur when companies run out of cash. And the fact that 19 occurred in the first full month of the crisis, and that the crisis has months more to run, tells me there'll be more defaults and bankruptcy. And there, as I mentioned before, there are large, highly levered companies and investment vehicles that the government and Fed rescue program is not likely to reach and take care of. So we believe there'll be plenty. It boggles the mind to think that we're going to have a crisis of the magnitude of this one and not have fallout. And typically, we have been able to profit from that fallout.
So is that to say that while Oaktree was buying aggressively in March, less so now, it may yet become a more aggressive buyer in the months ahead?
Absolutely. I mean, they, like they say in a football game, we take what they give us. And the greater the dislocation, usually the greater the bargains, which means the greater our buying. We think that there's a substantial opportunity ahead.
Howard, we know now that the federal bailouts and the stimulus programs that followed the financial crisis came at a social cost. One of those costs was the widening gap between the rich and the poor. You and I have talked about it. You've written about it. What do you think the costs of the pandemic bailouts and stimulus programs will be at a social level?
Well, more of the same. I mean, we've had a substantial rise in populism in this country and around the world. And I would describe populism as class resentment. And the bailout from the global financial crisis was easy to characterize as a bailout of Wall Street, not Main Street. The banks were protected and brought back to life at the same time that many thousands of Americans lost their homes, to put it in stark terms. And so that gave rise to populism and a class resentment. And I think that in this go around, number one, the banks are not in the condition they were 12 years ago, and so they do not have to be buttressed in the same way. And you know, I think it's absolutely essential, as I mentioned before, that this economic support be engaged in. But still, people will be able to say, look, they gave 50 billion to the airlines, and they gave this to that company and this to that company, and they bailed out the fat cats, and 20, 30 million Americans lost their jobs. So I would imagine that this episode will add further to that populism.
Howard, I want to thank you very much.
Well, it's always a pleasure to be here with you, Eric.